Johnson & Johnson. I mean, chances are you've got some of their stuff in your house right now, right? It's a corporate titan, a name everyone knows. And for a lot of people, it's the very definition of a safe blue chip stock. But here's the thing. What happens when we peel back the label and really dig into the numbers? Let's find out.
All right, so first up, let's just talk scale. In fiscal year 2025, Johnson & Johnson brought in a mind-boggling $94.2 billion in sales. Yeah, a number like that just screams stable, dominant, you know? It's the foundation of their powerhouse reputation.
So, with sales like that, you'd think it's a total slam dunk for any investor, right? But the most obvious story isn't always the whole story. The big question we've got to ask is, what's lurking just beneath that shiny surface? Are there risks the market's just ignoring?
Okay, but let's be fair. We should start with the good stuff, because there's a lot of it. I mean, J&J didn't get this huge by accident. The business itself, it's an absolute powerhouse by pretty much any measure.
I mean, just look at the sheer scale and diversification here. It's kind of wild. Get this, J&J has 28 separate platforms, and each one of them pulls in over $1 billion a year. And they are not resting on their laurels. In 2025 alone, they pumped over $32 billion into R&D and acquisitions. That is a serious engine for growth. And while the results really do speak for themselves, from 2024 to 2025, sales were up a solid 6%, and gross profit grew even faster at almost 8%. So on the surface, everything looks great. This is the picture of a super healthy, growing company. But now it's time to switch lenses. All right, so let's shift gears and put on a more skeptical hat. We're going to look at this through the eyes of Benjamin Graham, who's basically the father of value investing. He was all about finding what he called a margin of safety in any investment, basically a buffer just in case you're wrong. So does J&J actually pass his notoriously tough tests?
So what exactly is this margin of safety he was always talking about? Well, to put it simply, it just means buying something for way less than what you think it's actually worth. That difference? That's your cushion. If your math is a little off or the company hits a snag, that buffer is what protects you. It's really the foundation of smart, conservative investing.
Okay, and right here is where we hit our first big surprise. When you actually run Johnson & Johnson through a classic Graham checklist, the one designed for a super defensive, conservative investor, it fails. And I don't mean by a little bit. It fails big time on key things like debt, price to earnings, and price to book value. This is a huge red flag for a company that pretty much everyone thinks is the ultimate safe bet. Okay, let's get specific on one of those failures so you can see what I mean. So Graham had this rule. A company's long-term debt should be less than its net current assets. You can think of that as the company's emergency cash, what's left over after paying its immediate bills. So J&J's reality, they've got a whopping $39.4 billion in long-term debt and only $3.7 billion in that ready cash. Yeah, it's not even in the same ballpark. And that huge imbalance on the balance sheet, well, that's just the tip of the iceberg. The deeper we dig into the financials, the more red flags start popping up all over the place. Let's walk through the big ones. Okay, now look at this number. Negative $17.5 billion. What on earth could that be? Well, that's J&J's tangible equity. It's a pretty shocking number, and it tells us something absolutely vital about where the company's value really comes from. And here's why that matters so much. See, when you strip out all the intangible stuff, things like goodwill, which is just the premium you pay for a brand name when you buy another company, J&J's value in hard physical assets is deep in the red. That means its value is almost entirely tied up in these soft assets. There's basically no safety net of actual physical stuff for shareholders if those brands start to struggle. Okay, next up, let's talk about earnings. At first glance, they look awesome, right? But then you see this one line item, other income/expense. It swung wildly from a $2.4 billion expense one year to a $7.2 billion income the next. Whoa. When you see crazy swings like that from one-off items, it makes the big profit number really noisy. It becomes almost impossible to figure out what the real, repeatable earning power of the business actually is. And then there's this number, 73,570. This isn't about dollars and cents. As of late 2025, that was the number of people suing the company over its talc products. And that represents a massive, unpredictable legal storm cloud hanging over everything. Now, this isn't just a bad headline. This creates real financial uncertainty.
We're talking about a huge potential risk to the company's cash flow. Sure, they've set money aside for it, but the final bill? Nobody knows. And that unknown casts a very long shadow over the company's future. Okay, so let's recap. We've got a fantastic core business, but it's sitting on a shaky balance sheet with noisy earnings and this huge legal risk. So what does all this mean for an investor? Well, it all boils down to one thing: price. Is the stock's current price actually accounting for all these risks we've just uncovered?
Let's make this really practical. Okay, at a stock price of $220, the company's free cash flow, that's the real cash left over for investors, gives you a yield of only 3.7%. Now, if you're a conservative investor and you're aiming for, say, a 5% yield, the price would have to drop a lot, or the cash flow would have to jump by 35%. This really shows you the gap between the current price and the actual cash the business is spitting out.
And you know what? It doesn't matter which way you slice it, the story is pretty much the same. Whether you're using free cash flow, a conservative earnings multiple, or the old school Graham number, they all point to the exact same thing. A fair price for this stock is probably way, way below its current market price of $220.
So after weighing the awesome business against all these financial red flags and the high price tag, what's the bottom line? Let's pull it all together and land on a final verdict. The conclusion from this deep dive is pretty blunt. Speculative needs caution. And look, that's not a judgment on their products, their Band-Aids or their medicines. It's a verdict on the stock as an investment right now at this price with all the risks we found.
You know, in the end, Johnson & Johnson is really a tale of two companies. On one side, you've got this incredible scale, amazing profitability, and iconic brands. But on the other side, you've got a balance sheet that just doesn't pass the basic safety tests, earnings that are clouded by weird one-off items, and these giant legal question marks. Basically, an investor today is paying a premium for all the good stuff while also taking on all the bad stuff. And that really leaves us with one final crucial thought. It's so easy to fall in love with a great business, but as this whole deep dive has shown, even for the biggest and best companies out there, the most important question you can ask isn't just, is this a good company? It's, am I paying a safe price for it? And for Johnson & Johnson today, that answer is anything but clear.